Bank of Japan now actually owns more than 100%, literally, yeah, more than 100% of certain paper issuances, and they own the majority of others. I mean, effectively, they own pretty much, well, I don't know the exact percentage, but an enormous amount of the bond market. But you imagine if you had a 2-year and they own over 100%, you can see where the problems are.
Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Paul from the Sirius Report. Most of you are familiar with Paul. He comes on regularly on the channel. I recommend you check his blog, thesiriusreport.com, and that you also follow him at the Sirius Report on Twitter. Paul, welcome.
Yeah, good afternoon, Mario. Pleasure as ever to chat.
Good afternoon, and thanks for coming on. So I like to start with a tweet. I usually don't do this, but I actually took a screenshot of this tweet that you made on the 9th of February, so a few days ago, and you said, West is predicated solely on the basis of ludicrous asset bubbles, endless cheap credit, and fake economic data. The reality is now unavoidable. All this will have to return to the mean. So I thought we'd start with that, and maybe if you could elaborate on what you mean exactly.
Yeah, sure. Look, the one thing that's been very clear since 2008, when we went into this QE zero interest rate policy era, and what confused all the people is, well, we didn't create inflation apparently, but of course we did create inflation, and we created inflation in assets. I mean, just look at the housing market. If you go to the Netherlands, it's absolutely absurd, the prices of houses. And that's actually also predicated on the fact that they generally, I think for nearly everyone, doesn't matter what your earnings are, they give people 50% of their interest payments on their mortgage back to them. So you might as well immediately deduct 50% off the price of a house. I know it's a bit of a crude metric, but you get the point. So in a broader sense, we have all these asset bubbles everywhere, in equities, in bonds, and also asset prices in companies. I mean, the fundamentals bear no relation to the actual sort of share price. And it's the same. GDP is just a complete work of fiction, because they include things like government spending, recycled debt. I mean, where's the actual productive components of an economy in that? So again, you've effectively got inflation in GDP, for want of a better description. So when you're across the board, we obviously produce this economic data all the time, and it bears no resemblance to reality. So not just GDP, but job numbers, inflation. I mean, it's all manipulated to create the impression that the economy is ticking over okay, unemployment's low, the general economy is okay, we might slip into a mild recession, etc., etc. Not, of course, acknowledging that in 2000 they pumped trillions of dollars, pounds, euros to stop everything blowing up. That's how strong the economy is. And of course, that's contributed significantly to why we have price inflation effectively. So the reality is we've created these bubbles and all this artificial data to support the idea that what was done in 2008 was sustainable. And I've said this many times before, and I've said it on here, but I wrote to governments in early 2009 in the West and went, just don't do QE, zero interest rate policy, unless you want to do it for a couple of months and there's some intended purpose to it, then you have to abandon it. You cannot, because all you will do is create this environment of asset price inflation. It was inevitable eventually. You were going to cause inflation to seep into the main streets, as I've referred to it. So the rationale is everything has to return to the mean. This is what happens. Okay, we're not going to get into why we have boom and bust economies or anything like that, but quite simply, you have now this ridiculous, meaningless growth in assets, etc. And it has to return to the mean, meaning that all asset prices need to return to what they should be. GDP should actually reflect what GDP really is. So it's not really a question of that GDP is an accurate barometer of the economy, because asset prices should reach the mean, meaning they equalize effectively to what GDP is. GDP, for me in the West, should fall 50, 60%. Well, therefore, asset prices have to fall even further. So in theory, to reach this mean and have an equilibrium, so we're effectively have a situation when asset prices match the real economy, the real health of the financial system, etc., then you're looking at the biggest collapse we've seen in history, in any point in history, because we've never seen anything like it. And of course, there's all the endless cheap credit, which is now becoming much more expensive. And that's completely unsustainable. There's the small matter of, well, with interest rate swaps, there's something going on. It's hard to quantify because it's absolutely impossible that we haven't had the interest rate derivatives blowing up by now, given the hike in interest rates. So something is going on somewhere to bail that market out. And of course, the other part to all this is just how much secret bailouts have been going on of everything and anything, not just the obvious ones during the pandemic, because there was data that there's a person called Mark Skidmore who found there was effectively a black hole in, for want of a better description, US PLC to the tune of 21 trillion. I think it was then revised probably to 100 trillion. And then all of a sudden, all this data became a matter of national security in the US because they were a bit obviously upset that someone had found you can't account for all this spending effectively. So I would suspect it could be 150 trillion. I don't know. But the point is, that is another reason why we've got all this artificial kind of reality of our economy and of our financial system. And all these factors play into the one-day reality in relatively short order will have to prevail. And when it does, that's what I mean by returning to the mean. And there's no way around it. This is not sustainable, simply because this lunacy in the financial system that we've seen for 14 plus years, well, that is now seeped out into the real world. And they might be able to control this bubble inside the financial system, but they cannot control the inflationary pressure that exists and economic reality that's coming to pass out in Main Street. So we have a situation, they can tell us the Dow's at 34,000 or 35,000. They can tell us unemployment, whatever figure they want. They can produce all this statistical data. But the reality is, people are now having to spend 20, 30% more than a year ago on food, significantly higher in energy costs. This is where reality is playing out. So reality is already starting to crush the illusion. So that's in a brief way explaining what I meant by the tweet. It's interesting you mentioned it because I did have some people going, what do you mean by returning to the mean? But that's always what happens in 2000. And when we had the dot-com bubble in 2008, it didn't really deflate, as we know. It did to some extent, but not properly. So the argument is, what should the Dow really be? And we can't really quantify that. Should it be half of what? I would argue the Dow is probably 80% too high. That's a personal opinion. It's my investment advice. But I think that's how ridiculous and ludicrous the equity markets are. And we're now starting to see the insanity in bond markets to reflect, in a sense, the absurdity of financial markets in general. And it's now got to the point, we saw yesterday when the CPI came out, that the markets didn't know how to react. They were all, at 1 minute they were up, then they were down, then they were up. is wild gyrations in even in precious metals. I mean, if the algos and high frequency traders don't have a clue what's going on, then you've just reached the end of the line where there's just no reality to this anymore. It's just this thing that sort of functions on some level. But if anyone's paying attention to any of these markets and thinks it's a barometer of reality, then I think they're sadly very mistaken.
You mentioned the word lunacy, and I wanted to talk about Japan when it comes to the lunacy of monetary policy, because they kick started it, I think, in the early 2000s, in 2002, with QE, with the zero interest rates. And I don't know if you remember, I'm old enough to remember, there's a song called Big in Japan.
Yes, I remember that.
Alphaville, and
Yes.
I just looked it up here and about the lyrics, and it says the refrain "Big in Japan" symbolizes this idea of being successful in another world. Said gold. That line has a certain meaning. It means that if you're a complete loser, you're telling other people, "I'm not a loser because I'm really big. I'm because I'm in Japan. I'm really big." So, with that, I wanted you to touch upon the madness of the Japanese government bond market. I mean, we had the BOJ bought 153 billion, I think, in December to try to keep the 10-year yield from breaching 0.5%. And then in the last few weeks, I thought, well, it looks like it's stabilized, and they've been able to keep it at 50 basis points. But I heard you on your podcast from yesterday, and I was shocked with what's going on. And I've worked in the bond markets, and it's really hard to put your head around it. So maybe if you could go over what's going on there, and then towards the end, I'd want to touch upon, after we cover Japan, also how else, aside from having to pay 20% more for food, how else do you think this massive lunatic bubble will be reverted to the mean? Will it be through a deflationary collapse or hyperinflationary? So I guess I'm getting ahead of myself.
No, it's fine. It's fine.
Let's start with the Japanese bond market then.
Okay, well, just to refresh anyone who it maybe is forgot this or isn't even aware of this, obviously the Bank of Japan last year decided to adjust its yield curve control to 0.25%. From 0%, I remember at the time, I'm sure I tweeted it as well, saying they'll break 0.25% and they'll end up having to adjust it again. And then in December, of course, they upped the limit from 0.25% to 0.5%. So that's just a bit of sort of background. What obviously, as you're right, I discussed it in the podcast, was basically the Japanese bond markets have become, I mean, talk about insanity, have just become so dysfunctional. It's very hard in some senses to quantify exactly what's happening. So we can only look in broad terms. But what we identified, there's all these sellers who are now failing effectively to deliver on Japanese government bonds to buyers because of all this ridiculous amounts of purchasing by the Bank of Japan. And what does that create? Of course, it drives liquidity in the market. Now, obviously, failures can occur when buyers don't have enough money to take delivery and pay for a transaction of settlement, or when a seller perhaps doesn't own all or any of the underlying assets and can't make delivery. And of course, we have to also factor into our thinking with bond markets is just how much rehypothecation, how many people think they own a bond, when in reality they don't. And that might sound absurd, but I think that plays into this also. But what was noted in January, there was these failures, which affected, it was about 5 trillion yen of JGBs. This was in over 1,200 instances, which that was according to the Bank of Japan. And why is that significant? Well, It was the most, ironically, since September 2008 when Lehman Brothers collapsed. So that gives you an indication that we're not in a Lehman collapse moment, but that's the severity of the problem. So in JGBs, failures to deliver happens when sellers can't deliver assets within a business day of the trade date, meaning the settlement date. Now, obviously, when the Bank of Japan wound its policy for 10-year yields in December to 0.5%, there was this belief, and people, particularly overseas investors, were selling JGBs on the basis, well, they're going to raise the ceiling even more. You know, it's going to be 0.75% soon, or 1%. But obviously, the central bank just kept buying record amounts in January because it was going, well, now we're going to try and keep the yield down to 0.5%. Now, part of the rationale of that is, again, it's one of those situations where if you're heavily indebted and you start to allow the 10-year to rise, the risk is you're going to start causing huge problems in the economy. I don't know what the structuring of interest rate swaps are in Japan, but that's likely to be a problem as well. So there are various obvious factors in a long-term QE kind of zero interest rate policy environment. You, particularly even worse for Japan, you're very reluctant to allow the yields to keep rising on the 10-year. But this is where we stray into absurdity is the Bank of Japan now actually owns more than 100%, literally, yeah, more than 100% of certain paper issuances, and they own the majority of others. I mean, effectively, they own pretty much, well, I don't know the exact percentage, but an enormous amount of the bond market. But you imagine if you had a 2-year and they own over 100%, you can see where the problems are. And the irony, of course, is because they hold so many bonds, there's just not enough liquidity in the market. So this causes this failures by sellers. And I mean, the other problem is with regards to this kind of surge in fails, what it does is you causes this huge mistrust in the market, and it discourages anyone from wanting to make new trades, and rightly so, because you'll be sat there going, what the hell's going on? Why do I really want to be part of this market? And of course, because the Bank of Japan holds these enormous amounts of JGBs, essentially the market depends on assets note lent to financial institutions by the central bank in order to function. I mean, just to use the phrase, what could possibly go wrong apart from everything? And the Bank of Japan's actually tripled its lending in January. It was about 120 trillion yen. And it's only going to get worse. So, of course, because of impacting all the financial markets, all the market functions, you know, there's also the fact that there's this claim, well, you're trying to suppress the price so the government can keep spending. Because, of course, unsurprisingly, Japan's actually obviously has a budget deficit now. I mean, and a lot of Japan's problems relate to the fact it has to import all its energy, etc. And when you look at Japan's so-called outstanding general bonds, they have to be repaid with taxpayer money. That is over 250,000,000,000 yen now. That was for the first time, and that happened at the end of 2022. And if you look at total government debt, which is everything, it's more than 1.2, 1.3 quadrillion yen. So, of course, all this fiscal spending is growing because the government's responding to inflation. We're back to what's real inflation, not fake inflation data. And therefore, this, you know, the budget for the fiscal year 2023 is the highest ever. It's about 110, 120 trillion yen. And it involves issuing, what a surprise, tens of trillions of new JGBs. And then there's all the long-term interest rates are trending upwards. And of course, as usual, all these forecasts are made, going, well, debt servicing costs could increase by trillions of yen in the next few years. But they work that on the basis that the interest rate will be 1.6%. And as I said, what happens if it's 3.2%? What happens if it's 5%? You get the point. I mean, this is where this absurdity and this illusion, and it's now getting to the point where you cannot help but face reality, whatever they do or don't do. Reality is going to be extremely painful. And that's what happens. I mean, they got away with it for a long time, but there was always going to come a point, and it just happens that Japan's suffering this. I mean, there's an argument, are they leading the pack? I'm not quite so sure that's the case, but in a broad sense, they're now suffering for the consequences of idiotic QE zero interest rate policy. There might be an argument to say that they spent so long trying to obviously keep the 10-year at 0%. They're suffering even more for the consequences. But what do? I mean, they're going to have to keep printing more and more yen because there's huge budget deficit. How are they going to manage the bond markets in the future? I mean, you got illiquidity is an obvious case. How many more failures are there going to be? How many people or institutions own bonds and maybe 5 other institutions own? I mean, it's just farcical. Nobody really understands. But I think Japan is reflective of a broader problem in Western bond markets. I mean, we can't sort of say everything quantifies precisely what happens in Japan, whether it's in the United States or Europe or the United Kingdom, but it's a big indication of what happens when you have this illusionary insanity and eventually reality bites hard, and there's no way out of this. Or whatever they do, and it comes back to this point, what are they going to do? Just allow interest rates to rise and blow everything up? Or are they going to suppress this and just blow everything up because they're just going to keep printing and printing and printing because they've got no possibility of doing anything else? They're obviously suffering real inflationary problems. Their economy is stagnating and worse, and they're obviously subject to the fact they have to buy all their energy, and they don't have access to cheap Russian energy. So it was inevitable this is a problem the West faces also, if they're paying 3, 4, 5, 6, 10 times more for energy, you're going to create massive inflation because Japan needs energy and it might produce stuff, but that costs, and it's not a direct correlation. If energy costs 4 times as much then when you produce goods, it comes out 6, 7, 8 times more expensive. Well, then it becomes economically unviable for their manufacturing base to continue. So it's just all these things are coming together at the same point in time, and it's a nightmare. And everyone's pretending it's not a problem. And again, it's this situation where we're finding with central banks that rather like everyone's going, well, the Fed has to lower interest. It cannot keep doing this. And there's a logic why people think that. And everyone's going, well, Bank of Japan, they're going to have to let this go. It's going to have to go to 0.75% on the 10-year JGB. Well, it's not happening. And of course, it's causing all this chaos. And then what's increasingly apparent, I think, across the West is the idea that bond markets were safe havens is just dead in the water. I don't think anybody seriously regards bond markets as safe havens. I mean, just look at what's happened in the US yield curve in the last year. I mean, it's just absolute absurdity. Okay, at the short end, it's less of a problem because of the maturity, but then you've got problems at the long end and you can crystallize losses. And do you want to crystallize losses? And it's just, it's a recipe for disaster because you might have a situation where someone has to crystallize their losses because they've got no choice but to dump bonds. And the other point is, we're certainly seeing in the West enormous bond dumping across the entire yield curve in the US from the 1 month to the 30-year. I mean, the 1 month thing, was it the 6 month nearly hit 5%? The yield a year ago, it was like 0.4%. I mean, this is just the absurdity. This dumping on a biblical scale has been going on, and because for me, there's no confidence in bond markets. Yes, there might be margin calls, etc. But the more interesting point about this is, okay, we know what the Japanese are doing. It's very self-evident what the central bank's doing. But in the West, who's buying up all these bonds? Okay, bonds, sure, that's different. But who's buying all these bonds up? And where are they being squirreled away? Because it's not obvious. There's, for all the nonsense that there's all these foreign buyers of US debt, it's not true. So who's buying the treasuries? And someone must be, but where are they being hidden? Because the Fed balance sheet hasn't grossly increased on that basis. So don't want to get too conspiratorial. We don't really know what the answer is, but it's self-evident that confidence in bond markets in general have just whittled away.
Yeah, and I have noticed that in the last month or so, bond yields in the UK have started going up as well. And I think yesterday, the 2-year, which is a really important rate for mortgages, that broke out. It came off a bit today, but I don't think it's out of the woods yet. And the numbers you mentioned about Japan quadrillions, they're such huge numbers, and it's crazy that the government there, actually the central bank, sorry, it owns more than 100% of bond issue. It doesn't make any sense whatsoever, and I think it's going to continue. This is going to continue even, and I think the new governor of that's coming in April, he's supposed to be the Ben Bernanke of Japan. So it looks like what's going to suffer is the Japanese yen, because we've seen it, the dollar rise from like around 128 to 134 since the beginning of the month. And with that in mind, what do you think? How important? Could you tell the viewers how important the Japanese government bond market and the Japanese yen is to the Western financial system? And how do you think, this is, can it blow up? Could we wake up one morning and the 10-year JGB yield is up to 3% and the market has collapsed? It's really, or maybe the yen is, the dollar's gone from 134 to 170 because the Bank of Japan has had to print so much. I mean, this is, like you said, our government bonds really safe?
Well, yeah, exactly. I mean, it's difficult to quantify. I mean, anything's possible. I don't want to be, too sort of sensational about things because they're not what we do. But yes, I suspect, if it's possible. But then, if that happens, the Bank of Japan will then intervene again and dump a whole load of US treasuries and to try and obviously suppress the collapse in inverted commas of the yen. So they're just going to try and keep intervening. Of course, it's not a solution, and there is no solution to this. I mean, in terms of the problems with the Japanese bond market is there is a fair percentage of foreign investors in it in Europe. I mean, it can't necessarily earn in the United States now. Obviously, depending on what happens, if the bond market completely capitulates, could this create contagion effects in Europe? Possibly. I'm not convinced that would absolutely be the case, but there is a risk of this. So there are always contagion effects. And of course, ironically, and it's something I also mentioned, which I think is a good point to raise, is there's kind of, apart from the fact, the risk of the Japanese government dumping enormous amounts of US treasuries. And of course, it's worth noting that they had about sort of January in the last year or so, they'd gone from about, well, officially anyway, from 1.3 trillion of US treasuries to about 1.08 or something like that. So there's been quite a lot of significant dumping. No surprise that will have partly been to defend the yen. But the other risk, of course, with all this is that Japanese investors are now perceived to be more likely to pull money out of the US Treasury markets because there's this belief that yields in Japanese domestic government debt are primed to rise. So they're thinking, oh, well, maybe it's a good time to get out of US Treasuries. And if there's a belief you can have this rising yields on the Japanese government 10-year bonds, then there's a belief that you might get a desire for obviously Japanese investors with money parked overseas to repatriate capital. And if, of course, the Bank of Japan relaxes its yield curve control, that's entirely possible. And even though, of course, US government debt still paying the premium, there's a lot of fear because of what's gone on in the last year or so in the US debt markets. But the belief is, well, it's likely you're going to see more and more Japanese money piling out of the US Treasury market. What does that mean for US Treasuries? I mean, so there's this kind of, I wouldn't like to use the word contagion effect, but obviously there's certainly a risk that it could cause huge problems, depending on the amount of Japanese money invested in Treasury markets. And over the years, that's been quite significant. Why? Because again, the 10-year in Japan was at 0%. And okay, it's around 0.5% now. Okay, it's a lot lower than the 10-year US Treasury, which is, I don't know, about 3.7 anyway, percent. But there's this perception, while Japanese bond markets are now more attractive on a hedged basis, and therefore, it'll become even more so if they scrap this yield curve control. But then if they try to scrap the yield curve control, what's going to happen to the Japanese bond market? It's just this vicious circle. And we know, obviously, when back in September 2016, they kept the yield on the 10-year JGB at 0%. So Japanese capital left the Japanese bond markets and went looking for higher yields, including, of course, the United States. So it's all about this idea of, well, what do we think is going to happen in the US? What's the perception? People are trying to second guess what the Fed's doing, what that might mean for bond markets. And then the flip side is everyone's second guessing what the Bank of Japan might do. So maybe they'll pull their capital out and reinvest it into Japanese bond markets. It's one of these situations where it's extremely complicated, and everyone shouldn't really be trying to second guess what's happening, because even though, and this is why we're seeing situations where the market's trying to defy what the Fed's telling them, and because they're saying, well, the Fed is wrong in this situation, but it's, dare I use the cliche, don't fight the Fed. But typically, when you look at US markets, international investors used to borrow dollars at low interest rates to fund investments with longer durations. Now, that was fine when the front end of the curve had a lower interest rate than the long end, but we've seen this enormous inversion. So obviously that raised the cost of borrowing dollars and then eliminated the incentive for long-term yield. You're not going to borrow on it and pay 1% more than if so that you just end up with this situation where, because of this inversion, it's economic stupidity to be obviously trying to borrow on a short-term basis. I mean, because the yield curve is completely inverted. So again, this is one of these situations where it's a total mess in trying to understand what's going to happen in the future. The other point is that obviously the Japanese definitely accounted for a significant amount of US government bonds dumped last year, not entirely, of course. The Chinese were involved. And obviously, if you have a decline in foreign investment, I would say this is a bit mythical, this foreign investment story. If you have foreign investors actually not so much buying but dumping US treasuries, then that causes instability in the US treasury market. I mean, supply is increasing, and notionally the Fed's supposed to be offloading its holdings, or maybe it's just allowing bonds to mature. So there's always this concern. And this comes back to why bondholders may, decide they want to sell, but are selling when they want to sell. But if the market becomes hugely unstable, there's an economic event, a financial event, a geopolitical event, then there might be suddenly this stampede to get out of bond markets. Then everyone's going to crystallize losses. What does that mean? And it's very hard to do this, so that increases more risk in what happens, not just in terms of crystallizing losses. And if people are suddenly subject to margin calls, because as we know, there's way too much leverage. And then we've definitely seen flows also out of US corporate bond markets. And of course, it's the big story about, the US Treasury market's the safe haven of the world, because apparently everyone thinks there's liquidity and investors participate, but we know that there's a lot of illiquidity in the US bond market. So if you actually strip that facade away and go, what does this mean in reality? Well, you might get a situation where there is this, dare I say, contagion effect, where there might be a perception to get out of the US Treasury markets, and what might the catalyst be for that? Well, it could be Japanese investors. It could be, as we say, economic, financial, geopolitical event, but it just highlights this ludicrous instability in also the US Treasury markets, and not least when you've had the inversion we've seen in terms of the US, from the flip from obviously the short end is, so now obviously the yields are higher than the long end, and in an incredibly exaggerated way. But even you can see the general profile of it, and we don't know what will happen next week, next month, but the entire yield curve is also moving up. It's not just the flip, and everyone just goes, "Oh, this is indicative of a recession." Well, I think we should be less worried about it being indicative of a recession, which is obviously happening anyway, and more concerned that this is indicative of a completely dysfunctional bond market. And is these yields going to just continue rising so, maybe at the short end, they yield 7%, and at the long end, it's 6%. Maybe it's 8% and 7%. Okay, not saying it is, but trying to illustrate a point. And then we're back to this point, is just who then owns treasuries in the US? How much is rehypothecated as well? Does anyone own how much? What's the percentage of 10 years out there? Is it 120%? We don't know. I mean, because the bond markets, they're not orderly markets. I mean, there is definitely rehypothecation going on. It's not clear, to what extent this is a huge problem in the future. It's just this black hole and it's back to what we originally said, the utter lunacy that now exists in financial markets and financial data, GDP, et cetera, et cetera. It's just this endlessly idea that we can just keep having endless debt saturation, when it's very clear we're reaching the end of the line where we can't consume anymore, because and it's also self-evident in the US. They keep trying to kid us all, everyone's spending, but look at credit card debts going through the roof. People are not spending money they have; they're spending on credit for probably just essentials. And then what's the metric for measuring this in percentage terms of this idea of growth in retail sales? Is that because everything costs 10 times more? And are people actually buying less? But, I mean, how do they measure these metrics? It's all just ridiculous data that doesn't acknowledge the fact that we're reaching the end of the line in terms of debt. We've reached the end of the line in terms of consumption. And we've reached the end of the line in terms of our productivity, because what do we do in reality? I always come back to this point. For the US to be competitive, it will have to pay Chinese wages. Well, how does it pay Chinese wages? Again, everything has to return to the mean. Meaning, if you pay Chinese wages, what does a cost of a house have to be? This is the reality, and they're just not facing that reality, and they're pretending that somehow we can still pay, ever increasing wages, we can have all this inflation, but somehow we can be economically competitive in the West and sell our goods. Meanwhile, in the world where they don't have these problems, because as well access to cheap energy, etc., then they can produce a widget for a fraction of the price we can. We can never be economically competitive. And what are we proposing to do? Have this internal market in the US where everyone's paid, Chinese wages on steroids. You're just going to end up with endless price inflation because everything's going to just cost more and more to produce. And as everything gets more expensive, as we're seeing, not just in the UK, but everyone's demanding, huge wage increases. Well, that's, wage price inflation. If people are paid more, there is a consequence for that. It's just this snowballing effect. And this is fundamentally why we've reached the end of the line. And it doesn't mean things blow up today or tomorrow, but we have nowhere to go anymore. We've exhausted our capability to manipulate and bend our perception of reality, which is the illusion of reality, is going to have to be faced, and it will be extremely painful.
Wow, that doesn't sound great and doesn't surprise me. But maybe you could tell the viewers one final your final thoughts on how and I know there are different kinds of let's say people have different circumstances, but what would you say generally people need to do to try to protect some of their savings, be it in the financial markets, whether they should have a lot in these financial markets, seeing that they're really opaque and they seem to be like a black hole, like you said. And of course, this is not financial advice, so I'd appreciate if you could give us some final thoughts on that.
Yeah, that's fine. I mean, yes, as you say, it's just an educational discussion, but let's just very briefly explain something I think that's fundamentally important, because we have this perception in the West that that somehow we've tamed the energy market problem. We've weaned ourselves off Russian energy, which isn't entirely true anyway, because a lot of energy in the West being bought from third parties who bought it from the Russians, and like LNG, and then it's shipped to the West, or oil that's obviously sold to India, and then India then sells it onto the West. So, but the other point is we don't have long-term stability in energy markets, meaning that we can buy energy at the price we bought energy from Russia. That's the only thing that's enabled, particularly Europe, but also the UK to some degree over the years, is allowed us to have, I wouldn't call it economic prosperity, but to prevent economic carnage. Well, if we no longer have access to those markets, we're always going to be constantly paying higher energy costs, because at the moment there's no evidence where they're going to source cheaper energy. If I mean, they're already moaning at the United States for buying LNG 4 or 5 times the price. Well, again, we're back to the thing. If energy's 5 times the cost, then you in Germany, you produce a widget, it's going to cost infinitely more. So this is why we're seeing deindustrialization, and why, to some degree, and we're seeing companies more so moving to Asia, like BASF. So that's an important point, because on the basis of that, given energy is the lifeblood of the entire economy, or very way of life, then inflationary pressure isn't going to disappear anytime soon. Okay, they may magically produce a solution to this, but as things stand, there's no way of seeing that. So the risk is we're going to have continuous price inflation, producer price inflation. Of course, if you produce anything, even in the agricultural sphere, then food costs more, everything costs more. So the inflationary pressure is not going to disappear. They can produce any statistical evidence, but bear in mind they just don't include the things that actually cause enormous amounts of inflation pressure that affects us in terms of food, etc., and energy. So this is kind of the reality we're facing. for now, and we can only deal with what we know to happen. So this causes enormous economic instability. It's going to cause financial instability. So therefore, with regards to your question, okay, there are a number of routes for me, and it's up to people. Some people might be very skilled in entering bond markets. If you know how to do that, great. I'm not going to pretend to now have a clue how to do that now, and particularly not at this point, because for me, markets don't bear any resemblance to reality anyway. It's like trying to actually assess something with a blindfold on. You can't see anything. I can't make sense of markets anymore at the time. When for me it was very obvious it was to trade certain markets. I don't bother because it's impossible. But if you can do it, great. With regards to the issue of mining stocks, now I've made this point on Twitter for a few years. The problem with mining stocks is people will look at, well, it's going to produce this much gold or whatever it might produce. And they don't understand the broader CapEx issues, the OpEx costs, how their debt's structured, the jurisdiction they're in. There's all these factors. You don't have, a company sells 50,000 ounces of gold a year. You don't profit on the basis that, well, I'm going to sell this ounce of gold and I get the entire profit from the spot price. There are all sorts of factors that means the headline numbers look great, but when you crunch the data, the company's not that appealing. The other problem is when you have the environment we're in, it doesn't matter how good the fundamentals are. Mining stocks always tend to get hammered. And it's like in 2008, post 2008, there was commodities companies when in sort of March for me, 2009, they were the biggest steal in history. I mean, they were pennies and they were worth pounds. Well, we're not in that situation because, of course, we're in an entirely different environment now. Now, I'm not dissing all mining companies. I think there's some great companies, but you've got to factor in your thinking in a broader sense to the broader economic financial position. And this is why, and I warned people during the pandemic to be extremely careful with mining stocks, because you have a claim on an asset, you don't own the asset, and therefore that's an entirely different. And in fact, it's not even a claim per se on the asset. You have an exposure to a claim on that, so it's very, very different. So, but if you think you can invest in those, that's fine. If you think you can invest in equity markets, good luck to you. I mean, for me, it's a complete lottery. It's Russian roulette, effectively. Only in reality, nearly there's a bullet in every chamber, almost. So hence why we've seen an awful lot of people getting wiped out because of this belief that, well, I have this perception that gold and silver are going to increase to this value in the future, so this is a surefire winner. Well, it doesn't matter at the present time. The surefire winner is reflecting a whole bunch of imponderables, a whole bunch of inherent risks associated with that. And that's why they're not reflecting what people perceive that they should be. So when the gold price rises 10, 20, 30%, you don't reflect that in mining stocks, and often particularly junior mining stocks, which are a little bit precarious anyway, not least because there's always the concern, well, they might run out of funding. They need financing. Well, look at the markets now. If you want to refinance or raise money, it's extremely difficult. And I know people in the mining space, not mentioning who specifically, who've told me about difficulties in raising finance now. Well, at a rate, at a sensible value that, and I mean, it's all well and good raising money, but they want a ridiculous return on that investment because of all the uncertainty. Then, you might not be able to raise the capital, and your very business might go to the wall because of that. And it doesn't, you might have a great asset in the ground, et cetera, et cetera. So again, we have to be very careful. So from my perspective, Obviously, Mario shares the same view. You need to, and it's not about throwing everything into to gold and silver, and also you have to be comfortable with the investment. You have to understand what it means. Does it meet your profile? What would you be prepared to invest? What do you want to buy? Do you want it vaulted? Where would you vault it? What's the tax implication in your country of residence? All these things. And you have to take advice from someone who is allowed to give you advice on that basis. But the argument is it's wealth protection. It's as simple as that. It's not about, well, I'm looking forward to the day that gold's $10,000 an ounce. Gold could be $10,000 an ounce, and a loaf of bread cost you $100. This is meaningless. It's not the price, it's the purchasing power. So the argument is in the future, because increasingly the global south is making it clear that we're going to have a return to sound money. Now, okay, we're not here to discuss what that might mean in reality, but the point is, the argument is you want to hold real money in whatever you're comfortable with, and if indeed you are comfortable, if you're not, don't invest in it. It's fine. But to hold it on the basis then that will prepare you for all eventualities, whatever may happen in the future. But I always come back to this, and I've used this crude analogy, and I actually did it on here some point in the past, where I said, look, if you look at asset prices, they're massively overinflated. So you wouldn't take an ounce of gold now and buy a house, because that's not purchasing power. The argument would be that a house that costs £200,000 today, okay, we're just using the figure to keep the math simple, might be in the future priced at 100,000. And that people go, don't be ridiculous. But we saw in talking of Japan, housing market fall 80%. It's entirely possible that the housing market will crash significantly. It might only fall 20, 30%, but let's just say even if it's 150,000, and which is deemed to be a fair value for that asset. Well, there's an argument, of course, that gold will inflate in dollar terms, or pound terms if you're buying this house in pounds. And let's just say, for argument's sake, gold goes to £5,000 an ounce, just for simple maths. You're then able to buy that house with 30 ounces of gold currently. And just to keep the math simple, if it's 200,000 and gold, just say it's £2,000, it isn't, then it's going to cost you 100 ounces. That's the purchasing power. That's the point of holding this, because at some point when asset prices revert to the mean, then there comes a point when holding gold and by extension silver is less appealing, because then you can go out and buy assets that are fair value. And because you've held gold, and because of the appreciation in dollar, pound, or euro terms, whatever it is, then you also benefit in that capacity. So the argument is, if that's correct, of course, that you will then achieve the idea that you then rotate out of gold and silver and into tangible assets that actually do represent true value. Because at the moment, we know for a fact that all asset prices are nonsense. I mean, as I said, in the Netherlands, there's houses priced, it's absolutely absurd. I mean, beyond any comprehension you could. You just look at it and go, this is ridiculous. And people are still buying because, of course, they don't understand what's coming or the reality of overpriced assets. But that's the point of this. So that's the argument why you might want to consider this, but you need to go and consult with people who can give you advice and who are allowed to do that. We're just giving you an opinion and of what we consider might be something to look at. And for me, it's self-explanatory. I think obviously not putting words in Mario's mouth, but I think that reflects his viewpoint. But you might think on things differently, and I understand why people get very upset when gold falls in dollar terms or pound terms, but it's just irrelevant. We know the paper markets, like every other market, it's illusionary. What's the physical reality to the paper illusion? And we're talking about rehypothecation. Well, the argument is we see rehypothecation in gold and silver markets where there's enormous amounts of paper gold and silver backed by nothing. And therefore, on the basis, if suddenly everyone rushes in and wants their physical metal, it's impossible. It won't happen because there isn't enough physical metal to satisfy the paper contracts. We know this. So therefore, it is gross manipulation. But at some point, like everything else, all these markets have to return to the mean. And at some point, whenever that's going to happen, paper markets will blow up. They will not be sustainable. All paper markets will become unsustainable. And therefore, then we get true price discovery, and that then helps to start to make gold and silver appealing, to sell them correspondingly when asset prices reach their absolute mean or true mean. So we've kind of gone full circle to the very first discussion point, but that's needs the basis to at least look at it and show some interest in it, and go and get someone's advice who could give you advice, and take the advice accordingly, however you perceive. But as the important thing with this is, no matter what you're invested in, do not put yourself in a position where you have margin, where you're leveraged, or you're overextended. Never invest in anything, whatever it is, where you have an uncomfortable amount invested in that, because you'll constantly be awake at night worrying, well, I invested this much money, and in dollar terms it's fallen 10%, and people start panicking as soon as that investment falls. Well, if you're worried to that extent, don't invest in anything, because being brutally honest, in that situation, you're not cut out to be an investor, because there are always going to be situations when that happens. Okay, there's the flip side. You also need to know when to bail out of an investment if you make the wrong decision. Of course, there's always that, and some people just hang on, and then get wiped out because they didn't sell when the writing was on the wall. So there are flip sides to this. But in general, if you invest in something and you're constantly worrying about it, you probably shouldn't be invested, because whatever that might be, because it's not good for your health. You have to accept, well, from my perspective with gold and silver, that the paper price is irrelevant. It's, we say, an insurance policy. And if the house is half burnt down, which it is, or maybe more, then you can still buy an insurance policy. That's quite nice to be in the position that the house is burning down, but you can still buy an insurance policy if that's also okay. From my perspective, it's an insurance policy against everything. But if it's not for you, fine, don't invest in it. That's just you make your choices. But we're here giving some educational perspective of why we think might be something to consider. And so I know there's people obviously who listen who are very pro buying precious metals. I'm not here to convince them to do anything, or anyone else. It's just we're trying to give some perspective about why people might want to consider investing accordingly.
I couldn't agree more with what you said there about the mining stocks as well, and the stock market. And also gold, physical gold and silver. And it's interesting that you said that the paper market is not based on reality, that there's a lot more paper than gold, and it seems like the JGB market now, because the Bank of Japan owns a lot more bonds than there are. So it's totally crazy. So with that, Paul, I'm gonna thank you for your time, and wish you a very good rest of the day, and hopefully we'll be talking again soon.
Yes, pleasure. And yeah, always. I mean, if there's something you want to have a chat about, just get in touch. And yeah, I think the Japanese bond market's extremely important to discuss, and it is indicative of what happens when you have this abuse in paper assets. Eventually, the chickens come home to roost, and it will apply anywhere where we have this ludicrous situation of rehypothecation or something similar. That at some point the illusion has to give way to reality, and the argument is the Japanese bond markets are on the cusp of that. I would say the same with UK bond markets, European bond markets, the US bond markets there. And we've seen problems in the US Treasury markets previously. This is not, anything remotely surprising. We've had the repo crisis. We've had problems where there are structural issues inside the US financial system. So, and they've tried to paper it over with an illusion. Well, as we've seen with the Japanese bond markets, there comes a day when that illusion will have to give way to reality. And yes, there's the risk of contagion effect of what that might mean in a broader sense, but that's something we can't quantify. So yeah, I think there is a correlation of the illusion of paper markets in any asset class. I mean, anything where that, it might just not always necessarily equate like we do between physical gold and silver and the paper markets, but paper itself is just a gigantic illusion. It's a complete lie. And at some point, the lie has to give way. And unfortunately, the longer the lie goes on, the more they try to make the lie seem like reality, the worse the problems are in the future.
Okay, so thank you, Paul, and take care.
And you.